Hit my backup record. Testing. 3, 2, 1. Welcome. Oh, clap. 3, 2, 1, clap. Dennis. Hi, Dennis. Welcome back to QAV episode 622. We're recording this on Tuesday, the 30th of May, 2023 at 2:40 p.m. in the afternoon. We've just spent the last 40 minutes mostly talking about the Succession finale.
Oh my God, that was so good. It was on last night. That's what we're talking
last
about.
night. Yeah. We'll get into that more, I guess, in after hours. How are you, TK?
Good. Yeah. Yep. Good weather in Sydney. Played golf yesterday. Yeah. Went for a walk today. It's lovely.
Back's doing okay?
A little bit sore. Yeah. It's but it's fine. I'm managing it.
You're heading off to where?
Wagga. Down to Wagga, to Winter Wagga tomorrow.
The exotic play, it's the Las Vegas of Australia, Wagga. The capital of
Inland
fun
Riviera.
and entertainment.
Good old Waka Waka.
Yeah. Oh, that's good. Well, Chrissy and I got our COVID and flu booster shots on Thursday. That knocked me around for a couple of days.
Oh, really?
Yeah, not too bad, but, just kind of feeling not great for a couple of days there. Couldn't go to Kung Fu, that kind of thing. Did go and see Robert Forster on Friday night, which was great. Had a great night. Really enjoyed the show.
Lovely. Did you go backstage?
No. Why? Lines of coke and strippers and stuff. What do you think's going on? Backstage at a Robert Forster show.
Yeah. It'd be vegan snacks, wouldn't it?
Yeah, something like that. Yeah.
No, I thought Chrissy knew him.
She does, but she was playing it cool.
Okay.
No, and Taylor was looking after Fox, so we got home as quickly as possible. But Robert's wife, Karen, who Chrissy knows the best, got up on stage and did a few numbers, which was really nice because, the whole album is about her fighting stage 4 cancer, and the fact that she's still alive and could get up on stage and sing a few tracks was really, really lovely.
Yeah.
Shout out to Stuart and Jemima from Jindabyne, who I had their new club members, had a chat with them this morning, did the old welcome to QAV Zoom call, which was terrific. They're a lovely couple, getting their head around how to do a checklist and that kind of stuff. So shout out to all our new members. If you want to reach out and have a holding your hand session and talk you through stuff. It's actually, I said this to Stuart and Jemima, and I meant it. It's honestly my favorite part of the job is getting to talk to new QAV members and talk them through stuff, explain stuff. It's always good to get some FaceTime with new and not so new members. I like getting phone calls from members and having a chat. It's always fun.
This is not your favorite part of the whole QAV thing? Having
the second favorite part, apart from
40 minutes on Succession?
Yeah. Apart from talking to you every week, my next favorite bit, I'm talking about the work side of it, the admin.
Right. This isn't work.
No, this is the fun part.
Yeah.
Tony, if the US always comes up with a last-minute deal regarding the debt ceiling, as they have done this week, why did the market crash for 2 days, according to the AFR, out of concerns and trepidation about the looming debt ceiling negotiations? And then it just went back to where it was on Monday, bounced back when they penciled in some sort of a deal.
Yeah, I think the market isn't open yet in the US. They're on their Memorial Day weekend holiday, so it opens tonight. So we'll see what happens. But no, I agree. It's I don't know how many times I've seen this playbook, and it always ends the same way with a deal with minutes to spare, and the problem gets kicked down the road. It's a strange situation, but I agree with you. The only analysis I saw which made any sense was that was more to do with the bond market, and people just weren't prepared to take any risk that there could be a problem with the US government debt not being honoured, and so they just weren't entering the market, and the market was freezing up, which may have had some ramifications in the stock market if banks couldn't borrow or whatever. So, but it's and the sad thing about it is it's a bit like the boy who cried wolf. This is what, the 30th time they've done it or something. Next time they do it and they don't get a deal done, it's going to be a real problem because everyone's just going, it's a debt selling thing again. It's a sideshow. Forget about it.
I think there was one instance I can recall in the last decade when they didn't do it by the deadline and they had to start, putting people on, sending them home. I think during Obama's reign, they'd say government employees had to go home for a week, but it only lasted like a few days or a week or something, and they finally came up with something.
I don't know. I've got a distant memory. It may have been the Clinton years that they actually did drag it out for 2 or 3 months, and people were taking leave and stuff.
Right.
But the government never defaulted. They just didn't pay their employees for a while. So, you know who loses in these things? Not Wall Street.
No, no, it's the punters.
Yeah.
Speaking of punters, congrats to my old mate Dennis Bastis. I read in the news over the weekend that he's now worth $1.23 billion, his estimated net worth. So officially, I think the richest guy I know. As I always say, I remember Dennis when I had to take him out to lunch because he couldn't afford to buy lunch. He now runs one of the generic pharmaceutical companies in Australia. When I say runs it, like owns it.
Owns it, yeah.
And has done very well for himself. I haven't spoken to him for a couple of years, but Chrissy and I had lunch with him a few years ago when we were down in Melbourne. Lovely guy, soul of the earth, nicest, like you, but Greek. He's the Greek Tony Kynaston. Really, really, really nice guy. And I remember that he told me the story because when I first met him, he was running, I think he was running the digital arm of Village Roadshow in the late 90s. And then he was at a startup called ISIS, which was an unfortunate name for a startup in retrospect. And then, I think, then ISIS ran out of money. He was like the CEO of one of the divisions of ISIS. That went out of money. And he was out of work for like a year. And I'd take him out to lunch on my Microsoft card like once a week or every couple of weeks down in South Yarra. Remember, he went to Greece for some family wedding or something, and he came back and he said, I met this guy who owns like the biggest generic pharmaceutical business in Greece at the wedding. And the guy said to me, who runs all the generic pharmaceuticals in Australia? And he said, I don't think there is one. He goes, well, maybe we should enter that market. Dennis goes, I'll write a business plan for you. I'll go back and I'll research it. So he wrote a business plan for the guy. Then they did a joint venture and Dennis ended up running it. He called me up and he goes, any CFOs? I need a CFO. And I said, I know a guy. So that guy, who's my accountant at the time, became his CFO. And anyway, then they floated it and, then they sold that to a bunch of Indians about 4 years later for $400 million. And then he bought something else and he just keeps buying stuff and gets bigger and bigger. And now he's worth over $1 billion. And, just came from meeting a guy at a wedding in Athens and going, I could do that. Sure. Anyway, great story. I know he's a big fan of this show. Dennis never misses an episode.
Yeah, we should get him on.
Yeah, we should get him on. No, I've tried before. He doesn't like publicity, Dennis. Well,
he would have just enjoyed that last 5 minutes of the show.
Yeah. He was actually one of my advisors in my first startup before the podcast network when I did the startup called Golf Lounge, where we were trying to set up a online golf booking business in the, I don't know, like 99, I think it was. He was one of my advisors in that. There you go. Where were you then? You should have done that with me.
Yeah, that's probably would have been a customer.
Yeah. Well, that's when Princess Mary of Denmark worked for me. She was
really?
part of my Golf Lounge business. Yeah, it's another story. Yeah. Anyway, congratulations to Dennis. Lovely guy if you ever run into him. Doug Tynan uses a checklist, Tony.
Yeah, I saw that article in the Fin Review. It's interesting. Good on him.
Yeah, Doug Tynan has a simple investment secret, it said in the Financial Review. In a market crowded with macroeconomic crystal ball gazing and noisy high conviction stock picking, the GCQ fundy is building a business based on one thing. One thing. You want to know the secret to life? One thing. Doug Tynan loves a checklist. In a funds management market crowded with macroeconomic crystal ball gazing and noisy high conviction stock picking, the former VGI Partners executive is building a business based on one thing. Does an investment make it through an extensive vetting process? So far, it appears to be working. His flagship GCQ fund posted a 26.1% return for the 6 months to the end of April, outperforming its global equities benchmark by 17.6%. He says some of the key professions in the world, whether airline pilots or ER doctors, run off checklists because the world's a very complicated place. He's been listening to this podcast, Tony.
Yeah. Sure. Yeah. Gosh.
However, in a lot of funds management, the more experienced a fund manager gets, the less they use a checklist. An airline pilot with 30 years experience can fly the thing blindfolded, but they still use the checklists and they don't begrudgingly do it. And whenever there's an incident globally, they ground the planes, work out what went wrong and improve the list. We've done that with investing. Whenever we've made an error or lost money or not made the money that we thought we would have, we've stopped and said, how could we have avoided this with the checklist? So, found that interesting. You're not the only guy that's, a big fan of the checklist. Sounds like you read the same book you read, actually.
Yeah, it's the Checklist Manifesto.
Yeah,
good book.
You never run into this guy before, Doug Tynan?
Never heard of him.
Right. Well, maybe
I've got a feeling. No, hang on. I shouldn't say that. In the article, it said I think he was formerly from VGI Partners, who were a big short firm.
Yeah, right.
I've heard of them, but I haven't heard of Doug.
Wonder if we can get him on the show. Compare checklists. Yeah,
good. Because it seemed like their checklist was different to mine. It wasn't all necessarily numbers based. It was things like, has the company had a natural competitor for the last 20 years or not?
Right. Sounds very Buffety. Do they have a moat?
Yeah. Kind of trying to quantify those concepts, I guess.
Speaking of people how's your relationship with PwC?
Well, I stopped using them a couple of years ago. Which is a shame. I could have got some really good inside dope on tax avoidance if I'd stayed with them. Not that I would ever do tax avoidance, but that's terrible, isn't it?
Yeah, I was going to ask you what you thought of the whole PwC meltdown. Like, it's pretty appalling. Yeah.
Yeah. Well, my take on it is, particularly under the Conservative government, when they peddled the small government mantra, the public service was capped and even cut for staff numbers. But consultants grew, and they're now 25% of the headcount in the public service, which I think is the real appalling problem. You can't have these people who are advising you on the one hand and working for you on the one hand, then going out and advising clients on how to get you on the other hand.
Oh, Chinese walls, Tony. We've got Chinese walls. Chinese walls. It's all good. Don't worry about it. Never been a problem. Never been a problem in the history of corporations with Chinese walls. They always work, Tony, flawlessly, Tony. Just there's never been a book written about how the Chinese walls fell over inside of leaked. There's no leaks in Chinese walls, Tony. Never happens.
Few trapdoors. Few secret panels. Yeah. Press this one, the door opens. Yeah. So look, I know the public service is intransigent and difficult to manage people out of. And that's one of the reasons for not growing it. But they've got to rebalance that. So there's the headcount increases, consultants go down. And, I think PwC's just got to be put in the doghouse for a while. Federal government shouldn't have anything to do with them for 5 years.
Think that's going to happen?
No, because these people donate to the political parties, big time, big donors. Yeah. You want to go to the Olympics? Yeah, sure, we'll do that for you. Want to go here? Want to go there? Want to go to the footy? Want to go to the state of origin? Yep, no worries. Come to the PwC box.
Yeah. Oh dear, it's appalling. Speaking of appalling, Brettalator's had problems for the last week. Not Brett's fault
No.
at all. Seems to be, for me anyway, it's had a lot of problems in Safari. It just doesn't load, or very, very slowly anyway. Open it in Chrome and it works a lot better. So I think there's some sort of problem with Safari and Google Finance, and I don't know what Apple's done to Google, but something's gone awry. So if people are having problems, and no one's reported it apart from you, and me, I haven't seen anyone else complain about it. Maybe people just aren't using the Brettalator as much as we do. But if you're having problems, my tip is open it in Chrome and see how you go.
Yeah, that's the same thing I had. Yeah, I was surprised it wasn't all over the Facebook group, that it wasn't loading, but I had problems. And then that made me think it was just my settings on my laptop. But I got it working in Chrome. It could still be my settings in Safari, but I haven't been able to get it to work for a week now.
I didn't change my settings. It was working fine one day and then not working the next.
Yeah, same.
Speaking of things not working, did you know that Apollo Tourism is now THL? Have we talked about that?
Yeah, we did. They were going through a merger with a New Zealand company.
Tourism Holdings Limited.
Yeah, right. Yeah, that happened last year, I think, end of last year.
Yeah. So I noticed that Apollo was still showing up in our manual data in the checklist. THL isn't, so we haven't made the change. But I just wanted to let people know. Now, I know this is a very sneaky attempt that Apollo's making to get through my Apollo filter. It's not work. I can see what you're doing there, Apollo. You know, you're trying to get back in the QAV good books.
They're rebranding, yeah.
Yeah, they went through a rebranding exercise just to avoid my steely gaze. But
I wonder what PwC will rebrand to. National Government Holdings.
Chinese Walls Limited. Using GPT to find companies with a qualified audit. I had a question from Alex F on Facebook asking if anyone had tried to use ChatGPT to find companies with a qualified audit. So I did try. ChatGPT now, for the people who aren't aware, has access to the internet. If you're a premium subscriber, it has access either via Bing or via a number of different plugins. So I actually asked it I gave it Apollo Tourism's website and I said, can you tell me if this company has a qualified audit? First, I asked it if it knew what a qualified audit was, and it told me what it was. So it did understand that. Then I asked it to check if Apollo Tourism had one. It couldn't find one, but that may be because Apollo Tourism is now THL. The website sort of redirects there. I don't know. I know that in our manual data, we've still got Apollo listed as having a qualified audit, but I don't know if that's true now that they're THL. But then I asked GPT to give me a list of all of the publicly listed companies on the ASX that have a qualified audit. It couldn't do that. It basically said, go do your own work, you lazy bastard. No, it said, I'm sorry, I can't do that. But
beneath it.
But
that's beneath me. Yes.
Yeah. Actually, I'll read to you exactly what it's
puny humans. That's beneath me. Do your own work.
It said, as of my knowledge cutoff in September 2021, I don't have real-time access to such specific and up-to-date market data, including lists of companies with a specific audit status. However, this information can be potentially obtained, et cetera, et cetera, et cetera. And I said, hold on a second, you do have access to the internet. Can't you do it for me? I'm afraid I couldn't find a comprehensive list of all ASX listed companies with a qualified audit. However, audit reports for publicly traded companies are typically included in their annual filings, such as Form 10K in the United States. In the context of Australian companies listed on the ASX, these reports can typically be found on the ASX company announcements platform or the company's own website. The audit report is usually included in the annual report of the company. In these annual reports, you need to look for the reports of independent registered public accounting firm or the auditor's report section. If the auditor's report is qualified, it will be mentioned in this section. Then it tells me how to do it. And unfortunately, as an AI, I'm unable to automate this process for every ASX listed company you'd have to check each company's annual report individually or use a specialized database or service that tracks this information. But, I don't know about that. I think that as it progresses, we might be able to figure out a way around that. Alex suggested we just download all of the annual reports and feed that into it and say,
Yeah, right.
check all of these, which isn't easy to do yet unless you have your own AI running locally, which I've tried to do in the last couple of weeks and I haven't succeeded because I'm not quite nerdy enough to figure out how to do that, but some people are doing it with some success. But hopefully we will get to a point, is my point, in the not too distant future, where we will be able to say, here's a list of companies, go check their websites, find their latest annual report, and tell me if any of them have a qualified audit. That's not, I think a big stretch for the role of an AI in our investing research. What these generative AI systems are good at, these large language models, is reading stuff and understanding the stuff that they read. So you should be able to point it at a bunch of websites, say, find the latest annual report, read it, and give me a report. Build me a spreadsheet on, which ones have a qualified report and which ones don't. So
then we could
that'll make life easier.
We could also extend that for them to screen scrape all the figures we need as well, and cut out any sort of data provider.
Ostensibly, yeah. Yeah, you'll be able to get it to go through an annual report and turn all of the figures into some sort of digestible format. Yeah. I foresee the day in the not too distant future where we'll be able to use these AI tools for research in that kind of manner. People will probably build, and they already are building AI-based investing services where they're sort of doing this for you, I guess, basically grabbing all of the data out of Refinitiv or Reuters or somebody and putting some sort of a chat GPT style interface to it so you can query it and ask it questions. There'll be a lot of those. You may just be able to cut out the middleman though and point it at a company's website and say, tell me, analyze their financials and plug it into this sort of a checklist.
Well, I should have. Sure. I was kicking myself last week. I should have twigged to how we could benefit from AI when you started talking about it, because I noticed NVIDIA, the chip maker to AI systems, was up 25% last week. I should have gone out and bought their shares when you started talking about ChatGPT.
Yeah, Microsoft shares are up because they own 50% of OpenAI. NVIDIA shares are up. Google's shares, or Alphabet's shares, are up. Not sure about Facebook's though. I don't know if you saw this, but Facebook quietly killed its whole metaverse strategy about a month ago. Yeah.
So their rebranding didn't work either.
No. The $100 billion that Zuck threw into the metaverse has taken a back step now that it turns out AI is going to be the next wave and not the metaverse.
Well, there you go. There's a salutary lesson about trying to predict things, isn't it? If Zuckerberg can't get tech trends right, who the hell can?
Yeah, good point. Quick portfolio report. Dummy portfolio still tracking at about 2.5 times the benchmark since inception. I think we're doing about 16.2% per annum versus about 7% for the STW. For new listeners, inception's September 2019, so coming up on 3 years. 4 years, 3 and 3/4 years. For the financial year, though, the STW was way ahead of us. But, as I said to Tony earlier, our performance isn't bad for the STW, the financial year. We're up, 11% for the financial year. That's not too bad. I mean, the STW is up about 16%, so it's doing better than we are in one brief period of time. But being up 10, 11% in a year is nothing to cry about. For the for the quarter, we're basically at zero. now. We've come down a lot with the last sort of goings on in the market. And, the STW's, I think, up 1% for the quarter. So it's doing slightly better than we are, but there's really not much between us. It's been a miserable couple of months in the markets, as we know.
Yeah, and I think I was talking before off air with you. I had a look at, I'm trying to find something to buy at the moment. I thought I might be able to after the debt ceiling was resolved, but I still haven't quite got there with a couple of things. But I was looking at this commodity scorecard that gets produced every week by Alex, and everything is either a Josephine or a sell, I think with the exception of magnesium. And I can't even think which company mines magnesium, at least in a large amount. It's probably part of South 32 or something like that. But yeah, so that kind of shuts down a quarter to a third of the market for us to look at buying from. Yeah, especially in the large cap space, it leaves things like Qantas and QBE in my sort of investing universe, but they're both Josephines at the moment, so I can't buy any more of those. And nothing new popping up. So, and I guess the other thing about the commodities all being sells or Josephines is there's not much going on in the world economically to drive those commodities, so they're all going backwards as well. So. Yeah, like you said, not good news economically around the world at the moment. But as we also said off air, it's a great time to buy and to be invested, because things could turn around quickly, and when they do, they just pop.
Yeah,
and you want to be in the market then.
And that's, I think that's the hardest thing to convince people of. Like, I know there's been a lot of QAV members who have got started in QAV over the last couple of years, and it hasn't gone well for them, not because they're doing anything wrong or not because QAV doesn't work, but because the market's pretty much gone sideways for the last couple of years, down and sideways. As I keep pointing out, if you just look at the All Ords over the last 2 years, it pretty much hasn't moved. And depending on when you got started in your investing, it has gone up and down over the last 2 years and ended up back where it started. But depending on when you started and when you stopped, you could have lost 10 or 20% over that period. And that's, I can understand that that's psychologically and emotionally difficult for people when they get excited about something and they get into it. It's just the unfortunate truth that that's the way markets go at different cycles. And what from experience, and I know from your experience and from looking at your returns over the last 30 years, is down cycles in the market followed by up cycles in the market. And if you're not in the market when it starts, you never know that like our maxims say, you never know when it's turned around until later. 6 months later, you go, oh, wow, we're up by 20%. But if you weren't in it at the beginning of that, you've just missed that 20%. And there might still be another 20% left in it, but then you're up 20%, not 40%.
Yeah, and like you were saying, if you were a new investor and you're backwards by 25% in the last 12 months or last 2 years or whatever the number is, if I went back in time 2 years ago and said to you, here's the deal, you may well lose 25% in the short term, but you are going to get double market in the long term, and you get, when it turns, you're going to probably double the size of your portfolio, so you'll be out 75%. Would you take that deal? And you probably would. So please don't stumble at the first hurdle. Yeah.
Like, you got to take a long-term view with this. And, the money's not really gone when your portfolio goes down by 10% or 20%. It's not really it's not really gone anywhere. It's like ones and zeros somewhere.
Well, yeah, it's a counter. It's a token.
Yeah. It's a token. That's right. I know that's how you think of it. It's just,
yeah. It only goes if you sell up and take it out of the market and put it in the bank.
Right.
Then you've crystallized your losses. Yeah.
Yeah.
Yeah. Losing a bit of money is one thing, but losing confidence is everything. That's the old saying.
And as I was saying to Stuart and Jemima on the call this morning, one of the things that I've heard you say and Buffett say and Ben Graham say is long-term success as an investor is more about temperament than intelligence.
Mm-hmm.
It's about being able to just persist, have discipline, follow a system, weather the storms, ignore the hype, both ignore the doom and gloom during the dark times and ignore the rampant hype during the bubbles.
Yeah, because that's
equally as important.
Yeah, equally as important. And just 5 minutes ago, we were saying how good Nvidia's done last week. I would really caution any listener out there who's going, it hasn't worked for me, QAV, I've lost 10%. But if I had to put it in Nvidia, I'd be double my money now. I think, please don't go and put it in Nvidia. Even Kathy Woods, who runs the ARK funds, is being laughed at because she's going, AI is a new bubble, and I can't value Nvidia on the kind of lofty PEs it's trading at the moment. I just can't, even she can't countenance that kind of high valuation in tech. So yeah, it's a successor bias, right? You don't want to be late to the train.
Yeah. But what we do know is, history has proven for a very long time, companies that have a good track record of generating cash and good management tend to outperform businesses that don't have a good track record of doing that over the long haul. And if you can buy those companies at a discount to their intrinsic valuation, you'll do well more often than not. Not all of them will become a winner, and you'll have to rule one some and you'll have to 3 PTL some. But over the long term, more will do better than won't, and you will end up with double market results.
Correct.
That's what we know. That's what history has taught us anyway. I mean, past performance may not predict future performance, but your 30 years, Buffett's 60 years of testing that thesis has worked so far, and there have been downturns and global financial crises and various wars and God knows what else in that period of time.
Far more serious than the current period that we're in.
Plagues. It's a bit plaguey in Brisbane at the moment. They're doing burn-offs the last couple of days, and it's just the air is full of smoke and haze. And,
no.
Yeah. Anyhow, and you're having earthquakes down in Melbourne this week. It's the end of times, people. Maybe
dogs and cats
living together. We might have to do an update to Marketing the Messiah going, hey, we were wrong. He is coming back. It's 2,000 years late, but he's coming back. It's the end of times. Anyway, yeah, so the point, for the people out there that are second guessing or doubting themselves, you can do that. You can pull out and whatever, but crystallize your losses, as you said, but, or you can just take a long-term view, cool your jets, relax, deep breathe, don't even look at the numbers, just keep following the rules.
Yeah, just think about what we're saying is there are businesses out there that generate cash hand over fist that aren't out there on the front page of the newspapers every week. The more boring, the better that they are, because we can buy them cheaper and we can get them on 4 or 5 times cash flow, and yet people get drawn like moths to the flame and want to buy the latest big success story. Like they just hop from the peak of one market to the peak of another market, when all these things, the ones we're going to do a pulled pork on today, the ones I mentioned, Qantas, QBE, Macquarie Bank, they're all there. They're all so cheap on a cash flow basis, and yet because they're not out there making headlines every day, I know Qantas does for the wrong reasons sometimes, but they're not out there as sexy. The price that we're offered to buy these things is really cheap, and if you buy a good business cheaply, how possibly can you go wrong? All that can happen is management can stuff up. In which case, they'll be replaced. And you might go backwards for a while. The economy could stuff up, so politicians can stuff up. and that'll get fixed at the next election. And you might have to cool your jets for a while, but yeah, it's the age-old wisdom of the market. You're being offered cheap businesses all the time. But there's all this other noise around there to distract you. Don't look at this, look at that, don't look at this.
And there will be global financial meltdowns and crises and wars and trade wars and plagues, and all of that will come. As you know, one thing I've learned from you over the last few years is just that's business as usual, right? That's normal.
Yeah.
These come, the market tanks, then the market recovers, and then it tanks, and then it recovers, and then it tanks, and then it recovers. And
yeah. And we love the volatility. I just love it.
Yeah.
If
volatility is your friend.
Yeah. If Eugene Fama was right and the market is completely efficient and price discovery is perfect, then there's nothing to buy. But, we know that he's wrong, because every day there are good companies out there throwing off lots of cash flow who are offering their shares to you at a very, very cheap price.
And as Warren Buffett said at the AGM a couple of weeks ago, the secret to investing success is other people doing dumb things. That'll never change.
Yeah. No, exactly. I'm waving to Chrissy.
I saw that. Yeah.
Okay.
So you're going to do a pulled. Well, what have we got to talk about, Tony? You got anything apart from the pulled pork on your list?
No, we've covered it.
Okay.
That's everything. Thanks. Yeah, pulled pork. So I think we may have done this company way back at the start of our series, but I'm going back to a company that was called Eclipse and is now called Fleet Partners. So it's rebranded.
I added a couple of parcels of them to the light portfolios this week.
No, bad luck. Bad luck.
The only thing I could find to buy on Monday, and now you're going to tank it. So
well, it's why I'm talking about it, because someone asked us to talk about the next thing to buy every week. And not that I'm recommending this, do your own research, but it's high up on our buy list. It's Fleet Partners. And it used to be called Eclipse, and it's been on our buy list on and off for a long time, for at least the period we've been doing the show. And I used to own it before that. I don't own it at the moment. It's a little bit small for me at the moment. It's rebranded, I suspect, because no one knew what Eclipse meant. Like, what is it meant to be, a solar power company or something? It's eclipsing the sun. I got no idea. And it was spelt with an X. I got in on the .com boom years ago. It's Eclipse with an X. That's all gone. It's now, what you see is what you get. Fleet Partners, they manage fleets for large companies. They also manage novated leases, which is if you're working for someone and you want to lease a car and have it as part of your salary package, so you get some tax benefits, which are there. They facilitate that for you too. So basically, they're a funder of vehicles. They kind of manage the vehicle from cradle to grave, and they, if you're a large company and you have a whole fleet being managed by them, you're a manager, you get reports every month saying, here are the cars that are being serviced, here's how many kilometers of the, vehicles are doing, here's one that needs new tires, blah, blah, blah. And you also get some tax reporting. So they hook into your payroll and tax systems to just make it a seamless part of running your business and takes that headache away from the HR department. Been around for a long time. And successful. What else can I say about them? They covered all that. Got about 50,000 vehicles that they manage across Australia and New Zealand, so quite a large fleet base there. They do operate in New Zealand as well. And one of the things that they highlighted in the latest resorts is that in New Zealand in particular, with government subsidies for electric vehicles, they are seeing an uptick in business because of that. So people are sort of switching from older cars to EVs when they're available, and the government's providing some subsidies. So they're seeing more uptake of leased vehicles, and I guess an increase in the value of those leased vehicles as well. Not so much in Australia yet, because there's a little bit of support for EVs by the government, but not to the extent of other countries around the world. But it may happen in the future and would boost this business as well. On the downside, they came through COVID struggling because of the supply chain blockages with both new cars, which saw the used car market increase in value dramatically. That's starting to wash out, but they did call out the fact that even though orders for new vehicles are strong, they're struggling to, or the dealerships are struggling to supply new vehicles. And so their new business is down slightly year on year, I think about 3%, but the order book's strong. So once the supply chains refresh and flush out, then they'll be back to some growth. The other thing I should mention about this company is it's been undertaking a buyback now for the last, I think, 3 years, and announced that all of the profit, most of the profit from the latest financial results is also going to be deployed as a buyback, as subject to no better opportunities coming along to acquire something in this space, a business in this space. And so that's been supporting the share price for a long time. The logic for it from management's point of view is not just they think that it's compelling to invest in their business rather than try and buy another business or expand into new areas, which may be risky. But the other dimension to it is that they haven't yet got enough franking credits to pay out a meaningful dividend and have it franked. So they see a buyback as being a better way of getting value back into shareholders' hands, because obviously as you decrease the shares that are available, the share of the pie of earnings goes up, and the share price should go up as well for the remaining shareholders, which it has been. Did come off a little bit recently, but it's back on the buy list now. So they are flagging that the buyback goes this year. They're going to review it, and they expect at some stage in the future to have enough franking credits to maybe convert that into a dividend rather than buying back shares, fully franked dividend rather than buying back shares. So that's where that is. In terms of numbers, it's a reasonably high ADT stock. It's about $600 million traded on average per day. I did the sums on the weekend based at $2.15 as the share price. I think that's slightly below what it is today, Tuesday. So I think it's about $2.20 today as we speak, but not too different. Interestingly enough, even though it's a largish company, no stockbrokers, or not enough stockbrokers, are covering it to give us a consensus forecast to EPS, which I always think is a great benefit to us as private investors. We get to get into these situations before the analysts cover it and start recommending it to their clients. So that's a tick, I think. But I can't then check its IV2. IV1 is a little bit below the current share price. IV2 I can't give you. What else can I say? It doesn't have a yield, as I mentioned. Stock Doctor Financial Health is both strong and steady, so that's good. But the real hero of this story is the prop cap. So price to operating cash flow for this company is 1.7 times. So, if you buy this company, you get the cash back in under 2 years for your purchase. So that's pretty good. That's very good. PE is 7.1, 7.2-ish, which is not the highest or the lowest, so we can't score it for that. It is a new 3-point trend line upturn, so it came back onto the buy list in the last couple of weeks, which is good to see. We score it for that. Equity is consistently increasing, or net equity is consistently increasing, so we score it well for that too, which is good. I mean, if you consider that they're buying back shares and deploying capital that way, but the equity's going up, it's a pretty good story. So all in all, the quality is 10 out of 13, or 77%, which is good. And the QAV score is 0.45, which puts it way up the top of our buy list, largely because of that low prop CAF number of 1.7 times.
And the last time I checked, which was Monday, it was not a Josephine, still a buy on the Brettalator. I'm just checking it again now. Yeah, still good. Just barely above its sell line, as you said. Like, its sell price is $2.13. The current price is $2.19. It's got a fairly steeply rising sell line because it's coming off a L1 of the COVID cough still. and L2 of $2.09. So it's if it goes backwards for a heartbeat, it's going to become a 3-point trend line sell. But what are you going to do?
Yeah, it's pretty much the only thing out there to buy at the moment with of any decent size.
Yeah. So I said I added 2 parcels of it to the light portfolios yesterday because we're sitting on a ton of cash.
Yeah, right.
And I was just trying to invest as much of it as I
could
could.
also be one of the reasons why we're underperforming for this quarter as well.
Because we've been sitting on a lot of cash.
Yeah.
Yeah, absolutely. Yeah. It's been very hard based on our rules to invest in a lot of stuff. So the market's moving and we're not, because we're just sitting on cash and not even, investing it in a bond or anything like that to get any return out of it. It just sits in our trading account.
Yeah, which is actually probably underreporting, but that's fine. We could probably put it in the bank and get 3%, which if we wanted to, we could add to the dummy portfolio, but I don't think we should. We'll be fine.
Yeah. All right. Well, FPR, thanks for that. Let's get into the couple of questions, I guess, that we've only got a couple this week. Dave from Newey is the first question. G'day, Dave. He says, I know Tony has covered this before, but could we please revisit why QAV uses operating cash flow versus free cash flow? Would be nice to have a refresher.
Thanks, Dave. G'day, mate. Thanks for being a long-term listener. You've been around for almost since the beginning, I think. So it's great to have you still throwing these questions at us. And this is a good one. I guess the first comment I'd make is if you want to use free cash flow, feel free. I don't. And the main reason is because operating cash flow is the highest of the accounting purity tree in my book. It's the top level of all the accounts, and therefore there's less manipulations by management that go on before the figures are reported. Whereas free cash flow sits down a little bit further, and it's Investopedia defines the two as operating cash flow measures the cash generated by a company's business operations, and free cash flow is the operating cash flow less the capital employed. There are some other sort of nuances in there. Sometimes free cash flow includes depreciation and amortization. Sometimes it includes all three: CapEx, depreciation, amortization. But again, that's another reason why I don't use it, because it's subject to
fiddling,
I guess, people's input into how it's calculated, right? And if for some reason management decide to spend a lot on capital this year, the underlying business still might be throwing off lots of cash, but we're not going to like it if we, do our checklist based on free cash flow. And this is one of the examples again of where the kind of rubber leaves the road in terms of what the classic financial teachings say. And I haven't been to an MBA school for a long time, but they would say things like, you want to be investing in capital light businesses. And that was the whole basis of the .com, bubbles, because the tech bros said, look at us, we're throwing off lots of cash and we don't have any CapEx. And then they started, people started doing valuations on EBITDA, which was earnings before income and tax and depreciation and amortization. In other words, let's look at how much cash we're throwing off without worrying about the CapEx requirements of the business. And they said that because they said, well, we're CapEx light. We don't really worry about CapEx if we're in the cloud and all that kind of stuff, which is not quite true because they have server farms and all that kind of stuff. But compared to a mine, which has lots of CapEx, they're right, they're CapEx light. And so they tend to have large return on asset figures and large ROE figures. But the downside was everyone jumped on those and their PEs went up, and so you weren't buying them cheaply. The flip side is if you are in a capital intensive business, you've kind of evolved ways of taking that into account. So if you're a large retail firm and you have lots of stores, well, you don't own the stores, you sell them off and then lease them back. So you're converting the CapEx charge to a leasing charge. Now, does that make Wesfarmers a CapEx light business because it leases all its stores rather than owns all its stores? So, it gets the whole role of CapEx in business from a scorecard point of view gets a bit hairy, I think. And I can think of as many capital intensive businesses which I'd rather invest in compared to CapEx light businesses, because it's a case by case type decision. And if, you know, I guess going back to our coffee shop analogy, if you think about it this way, there's two types of coffee shops. There's a capital light one and a capital heavy one, even though the capital heavy one isn't going to be that capital heavy. But if you think of a coffee shop being a hole in the wall, so you just have a machine and one person serving coffees, there's not much capital involved in that compared to a large coffee shop which has the retail property and the tables and chairs and all the rest of it. And so the capital light business has a better margin, but it has problems scaling, right? So the capital heavy business can also do adjacencies. It can sell food. It can offer free Wi-Fi. It's a place to go to when it's raining in it, or if it's in a particularly cold place, it's a place to go to get warm. So there are benefits from having that capital intensive sort of business in that sense. But also too, the capital heavy business can actually get the sort of margins of the capital light business through economies of scale. So the margins may look skinny on a one coffee shop operation, but if you bought 5 and then amortize the management costs across all 5, the margins go up. So, and the capex goes up too, but you're making better cash flow. So there's always swings and roundabouts with these things, and it's the capex business actually wins out in this particular case. That's why we see Starbucks as an international chains and McDonald's and McCafes are a national chain, but you don't see any national hole in the walls chains because they're difficult to scale. So I prefer operating cash flow, one, because it's less manipulated by what's in or out in terms of capex and potentially depreciation, amortization, and two, because I think you can negate the effects of capex on the business in some ways. Then we're not taking, like when we're doing this discussion about capex light, capex heavy, we're not taking into account gearing, not taking into account leasing, all those kinds of things. So I prefer the simpler approach, and I'm not discounting all the other comments about depreciation, amortization, capex, all that kind of stuff, but we tend to take those up in the financial health ratings and in the scores for equity and increasing equity and things like that. So if it was a capex heavy business that was doing poorly, then the equity goes down. But we don't score those businesses well. So we tend to take up capex in a slightly different way. So that's why I prefer operating cash flow to free cash flow.
Thanks, Tony. Thanks, Dave, for the question. Last question's from Sam. Question about VEA. I bought it on Friday and noticed it's a sell on the buy list. I suspect it's because of the oil/Brent being seen as an underlying commodity. Can you confirm that is the reason for the sell sign? Yes, I can. Already told Sam that on Facebook or whatever it was. Yes, crude oil is its underlying commodity, I think, and we've decided that's a sell. But then he says, I would like to ask the consideration as to why the commodity is affecting the share price. I've suspected that the company is deriving much more profit from the price of petrol going down and thought that should play positively. On the negative side, if the price of oil is low, it is perhaps in part due to the expected slowdown in the economy in general. So I did a comparison on Stock Doctor between the share price and the price of oil together with WDS and BPT. Not too sure what to think of the graph, but I would like to ask you if you could provide consideration as to the correlation between VEA and the price of oil.
Yeah, good question. And I actually did the same analysis over the weekend, trying to find something to buy. And VEA has been going up, which is attractive. However, oil's been going down, which isn't attractive. And I think the correlation is there. I did, as Sam did graph them both. And apart from the sort of period where the Ukraine war started and oil went up dramatically, they do follow a similar sort of trend historically. And yes, they did part ways in the last sort of 12 months or so, and oil went up dramatically and VEA didn't, but oil's coming back to that sort of trend that VEA's been on for a while. Why do I think they're linked? Because, I used to work for Shell, which is the predecessor to Viva Energy. And it has this Geelong refinery, which is buying crude oil and then refining it and selling it through the Shell service stations as petrol for the cars, diesel, unleaded, whatever. And so I think there is a correlation to that underlying commodity. I'm having troubles with Stock Doctor at the moment calling up the graph. Sorry, so I can't get it to load. But yeah, apart from the last sort of little while when oil went up dramatically and VEA didn't, I think that's a bit of an anomaly because of the Ukrainian war. I think, and the fact that oil's coming back down again is making more sense to me. The interesting thing is, though, that the business is changing again with Viva. So back when I was working for Shell, convenience stores were starting to become a thing, and that was an income stream for Shell. And then it sold off its service station network, or actually offered a 99-year lease to Coles, and became the wholesale fuel supply to Coles. And so it was very tied to the crude oil price because it wasn't getting any income from the convenience stores. And in the last sort of, I think 6 months or so, it bought back the convenience stores from Coles Express, and now Coles Express is going to be the wholesale supplier of product for the Coles Express stores. So VEA is, I guess, trying to diversify. It's getting back into the convenience store game. And they're also announcing that they're seeing a role for EV charging on the outlets going forward. So it's possible the crude oil linkage to the graph might break in time as convenience store income plays a bigger part. But at the moment, I think because of the Geelong refinery and because of the fact that up until recently it's just been a crude oil wholesaler, I think it's pretty tied to crude.
It's interesting. I just did the comparison that Sam mentioned on Stock Doctor. So I've got VEA, WDS, BPT, and crude oil futures current. It's interesting how VEA, WDS, and BPT are mostly in lockstep. There was a period when BPT spiked in late 2019, but then it fell back down again. The three of them have pretty much been in lockstep for the last 5 years. And as you say, crude oil started to rocket up in January 21. I just did a bit of a look on what happened to crude oil in January 21. And it said that observed global oil stocks fell by 2.58 MB per D in 4Q20 after preliminary data showed hefty drawdowns towards year end. In November, OECD industry stocks fell for a fourth consecutive month. And so oil's rally accelerated with Brent reaching $57 per barrel on the 12th of January, a level not seen since February 2020, et cetera, et cetera. So, yeah, it looks like there was some stuff going on with, I don't know, manipulation of the global oil markets, 2021, 2022, OECD and Russia and blah, 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 all that kind of stuff was going on.
Yeah, and also too, around that time, VEA did start to trend up, just not as sharply as the oil price did.
Yes. Let me see. What's VEA's line? Black line. Yeah, 2021. Yeah. Well, they all three of them went up a little bit. Not in early 2021 as much, but later on, sort of late 2021, all three sort of started to spike for a little bit. But yeah, and they all went up, sort of in May of 22 as well. They're all gradually increasing. But yeah, oil really shot up after the Ukraine war started,
Yeah. So these correlations are never going to be one-to-one. Because as you say, there's outside influences in the market for both sides of the equation. There's outside influences in Viva's side in terms of how Australia's doing versus the rest of the world, or how their business is doing, what investments they're making, etc., what deals they're doing. And on the flip side, crude oil is also being traded in the market through other means, not just being sold through refineries. So it'll have other impacts on it too. But the trend, I think, is there to see.
So you're still comfortable that with crude oil being a sell, takes VEA off of the buy list for us.
I am, yeah. I can't, I mean, again, just think about the business. They're buying crude oil, so the crude oil is getting cheaper. They refine it and then they sell it through retail outlets. Competition in the market will eventually, trade away their margins back to the normal competitive level. So they'll go down. And if the crude oil price is going down and you're making 10%, you're making 10 in a cash sense, 10% provides you less cash than off a smaller oil price than it does off a larger oil price. And, and also too, it can have effects. Like if the oil price is high, so what am I trying to say? If the retail pump price is $2 a litre and everyone's making 10%, you get 20 cents cash. And if the price drops to $1.50, you get 15 cents cash. So, but the margin stays the same. So I think that's what happens in a rising market versus a falling market, and it's falling at the moment.
Well, that makes sense. I hadn't thought about it like that before.
Yeah.
10% of a smaller amount is a smaller amount.
Correct. Yeah. Yeah, and because it's a smaller amount, it puts more pressure on you to keep your costs tight. The refinery's got to run lean, all that kind of stuff. So it becomes harder.
Toy like a toiger. Well, that's that. Thank you, Sam. That's the end of the questions for this week. Quietly,
yeah, two good ones though.
Again. After Hours. If you haven't seen the final episode of Succession, I suggest you turn off now because this is going to be full of spoilers.
But please do. It's so good.
So good.
The whole last season, really. That's some of the best TV I've seen in a long time.
Yeah. And it was full of twists and turns and who's on top and 1 minute to the next and hubris and failure and just despicable people doing despicable things pretty much.
Yeah, not even doing them well. Just incompetent people doing despicable things.
What did you think of Mattson by the end of it? Like Chrissy pointed out that he'd been coming across as pretty insane for most of this last few episodes. But in that last episode, he just seemed he won. And
oh yeah, he was just on a different level. He was way above everyone else, wasn't he?
Yeah.
He just manipulated. He came across as being this sort of, tech bro, lightheaded, off with the pixies kind of guy. But he was just playing everyone.
Yeah. Yeah.
And occasionally he'd take a hit, but he always came through.
Yeah. And I was never quite sure. I mean, Alexander Skarsgård did a great job as that character, but I was never quite sure if his sort of zany, crazy tech bro moments were real or being played for effect to try and give the impression to the people around him that he could be played. And when they tried to play him, he didn't win that. Like when it came down to the board vote in the end, it was 6-6.
Yeah.
It was tight. He could have lost that. It came down to the final vote, Shiv, and Shiv just, as her name suggested, shivved Kendall. And why do you think she did that? What was her motivation at the last second to put the knife into Kendall?
Never one thing. I think she changed her mind that Ken was up to running the company. And when she found out her estranged husband was going to run the company, probably thought, I get my money and who's better than Ken at running the company is going to run it. So I'm swapping sides.
Well, she already knew when she and Roman, when they were wherever their mother was in the, I don't know, Caribbean
somewhere. Yep.
Yeah. When they did the deal, when she and Roman were talking about whether or not they should give Kendall the job, they both said it's going to be a disaster. Like he's going to fuck it up. Like they knew that. There was no doubt about that at that stage, but they decided to give it to him anyway because rightly neither of them were an acceptable candidate. It really, out of the three of them, it had to be him. But I think it changed when they were in the off the Waystar offices, and he sat down in Logan's chair and immediately put his feet up on the desk and started spitballing about making Stewie like proto chairman or something, and waving off. Stewie's like, no, I'm got too many sexual stories, and I do a lot of drugs, and and he's like, so you kiss some boys on the mouth when you're high on Molly. Not a big problem. There was this shot of her in the background just looking disgusted at Ken with his feet up on their dad's desk. And I just think she was like, no, I just can't.
I didn't pick up on that, which makes sense from, the way you described it. But I think just following it through logically, she didn't know. Did she know Tom was going to be the CEO apparent the night before on wherever they were, some Barts or something? When they made Kendall, all she knew was that she'd been promised it, then had lost it.
Yes.
So I think that's a different kettle of fish to when she finds out that Tom, I think she meets him in the apartment the next morning when they're putting stickers on the father's items to take back.
Yeah.
And she finds out then. And then I think she's got to process all that. And then, as you say, Ken being a dick, it all goes into the mix, and I think she swaps sides.
And even in the board meeting, he was just the hubris. There was no sort of humility. There was no attempt to put forward a coherent argument. He was just so confident that he had the numbers and he had the votes, and just yes, he was appallingly hubristic.
And I particularly like the acting of the old guys, the CFO and the chair. They were talking before the board meeting and after the board meeting, and the CFO goes, well, I might stick around a bit longer. And the chair's going, really? Yeah, one more go on the rodeo. And like they've seen it all before. They're on the outer, they're on the inner, they're on the outer, they're on the inner. They're just going with it. That was really good.
Yeah. And then Tom's decision at the end is going to keep Jerry because she knows where the bodies are buried. Get rid of Frank and Carl. And what about Caroline? Caroline makes a play for Shiv just before the board meeting, get rid of Hugo. And then when Hugo comes up to Tom at the end and says, something, 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 Tom's just like, where's Caroline? And Hugo knows that Carolina, Hugo knows that his day's over. He's done. She's played him. Everyone's backstabbing everyone else, playing everyone else.
And Carolina's line to Shiv on the way into the board meeting was, it'll be great to have a cultural change and there won't be any backstabbing going on anymore in this company.
She backstabs her boss.
But
I think like the great overarching message of the story they told is just about incompetent people who are full of hubris, and because they've never been told no, really, by anyone except their father for their entire lives, because they're rich and entitled, and they just they just surround themselves with obsequious yes men and women who never, told them the truth. And till the very end, when a couple of people at the tailgating party, Nate said, you're not your father, and that's a good thing.
That's a good thing. Yeah.
But also the other story is Tom, the obsequious, the ultimate obsequious yes man pain sponge, as he put it, comes out sort of on top. I mean, he really doesn't have any power. He's Matsson's front man / whipping boy. And he's probably not long for the world either. I mean,
no.
I think if the show ran for another season, Matsson would get rid of him. Once he'd fired 25% of the workforce and they rebranded it to Gojo, Tom's gone. He's done. But Shiv's still got a couple of $1 billion. So, he'd be off her playlist just as quickly as he was back on it.
But didn't he love the fact that he was made CEO? Like, you could just see him standing up a bit taller and doing his button up on the coat and straightening his tie, and then putting his hand out in the car for Shiv to take, and he was just on top of the world. He loved it.
But in our corporate careers, how many times have we seen the obsequious yes man or woman who's never had an original idea in their lives and never tried to fight for anything? They're the ones that tend to survive because they just find a way to suck up to whoever's in power at any given time. It's like I remember one of my managers at Microsoft telling me once, your job is to make me look good.
Yeah. I remember I worked for a guy who I didn't like, and he was new into the business, and I'd known him before, didn't like him. But a good friend of mine was his PA, and she took me aside one day and said, he really likes you. You should use that. I just thought I can't.
Yeah, right. Yeah.
Yeah.
Yeah. And that's, I guess that's a little bit about what the psychopath epidemic was all about. There are those of us that just can't, I just can't do certain things. I mean, I can't stomach. I don't have the stomach for doing certain things, for being a yes man or telling people.
I don't mind hitching my star to someone that I respect and has talent.
Right, sure.
And they may lose in corporate politics because they're probably going to have a certain degree of values, and they'll get screwed at some stage. Never had a problem hitching my wagon to that kind of person, but just unhitching it, hitching it to the next person that comes along in power, and then unhitching that. And it's just, it's disgusting.
No, like if there's somebody I genuinely respect that has a vision, is a decent human being, absolutely happy to get on their team and support them to the hilt. But the snakes in the grass, when they, say, look, I know you don't believe in me or in this, but just go along anyway and do it, or else I just can't,
Yeah. Well, it was like a couple of episodes before, during the Gojo takeover when it first started, and Ken decides he doesn't want to sell his shares and wants to take over Waystar Royco, and grabs Hugo and makes him an offer to come across to Team Ken and get paid a lot and do his bidding. And Hugo just goes, yep, I'm in.
Yeah. All you have to do is start leaking that dirty stories about Logan, how he was losing it, et cetera, et cetera. Just start leaking negative stuff. And then when Shiv confronts Kendall about these stories, he denies it. But then when she turns around and betrays him by leaking stuff to Mattson, he's furious that she's betrayed him. Like, they're all just, it's very Shakespearean in the end. It was it was King Lear in the end. Everyone was shafting everyone else, and no one had any ethics or morals or values, really. When Roman makes the call and Tom supports it to make Mencken the fascist Republican candidate president, to call that, she is appalled and storms out. And then the next day at the wake for their father, she and Mattson slide up to Mencken and they're trying to cut a deal. She's like, yeah, that was yesterday. Yesterday I thought you were evil. Now you're the presidential
presumptive president.
Presumptive president. Yeah. Now that's all. Everything's on the table now. It's a good show. It's very rare that you get a show these days that actually nails the landing. I think The Sopranos did it. Deadwood didn't really get a good finish, but did with what they had. The Wire, I think, did it. What was The Shield did it.
Yeah,
Breaking Bad did it. Better Call Saul did it. Have you finished Better Call Saul yet?
Nah, still up to season 3, halfway through that.
Better Call Saul nailed the ending, just absolutely perfectly, beautifully executed. But then you have the Game of Thrones that just screw the pooch in the end. And there's lots of shows. I think, sadly, the vast majority just run out of steam and run out of ideas.
Yeah, I think The Shield did too. But as much as I love The Shield, that last season was a shit show. Really?
Really?
Yeah.
No, it was. What didn't you like about the last season of it?
Oh, it was just kept going on and on about, was a new, let's get the money train. Let's, the mayor was compromised. What was her name? Who was the famous actor from Fatal Attraction? Glenn Close comes in, plays the
was great.
Head cop. Yeah.
Forrest Whitaker. Forrest
Yeah,
Whitaker trying to bring Vic down. Yeah. I love the last season, just that Taylor always tries to call me when we're doing these shows. You think he'd have learned after 4 years. The way that Vic was just betraying everyone in his circle, just like tossing bodies, left, right, and center just to try and survive. And then the ending when he's had to give up the strike team, they've got him cornered in a little office doing a desk job, and he just grabs his gun out the desk and he just has this look on his face, and he's going out there to stir up some shit. They can't keep Vic quiet.
Again. Yeah.
I'm dying for the sequel. I want them to do the sequel. The shit Vic gets into part 2. I tried to watch The Shield yesterday. I was waiting for Chrissy, and it's gone off all the streaming services. It was on Prime Video. I went to watch it. No, it's all gone down now. It's gone dark. Pisses me off, man, that I subscribe to like 5 streaming services, and there are still tons of shows that you can't watch. They're just gone. They're in the void somewhere.
Oh, the other thing I wanted to mention too is I'm loving the Ehrmantraut character in Better Call Saul and how that's developing. That whole story arc there. It's a great character. Great actor too.
Yeah, one of the great characters, and his performance is just gold. Yeah.
Yeah, it's good.
I don't remember what he was up to in season 3, but sort of.
So he's just put, is it Tuco or Loco into jail, took a beating from him in front of the cops and dropped his gun. So it made it look like it was Tuco's gun. And now he's, the crime boss is paying him $50,000 to say it was his gun. And he's been beaten up, but he's got everything worked out like a puppet master.
That was to save the young guy.
Yeah. The second in charge.
Yeah.
He wanted Ehrmantraut to kill. Yes.
Nacho, yeah.
Wanted him to kill Tuco, and he said, no, I've got a better idea. I'll put him in jail.
Yeah. Yeah, well, it's, man, I'm kind of envious that you've got a couple of seasons left to watch on that, because it's absolutely fantastic. The other thing that I've been watching, I mentioned to you off air to give it a plug, not as sexy, is University of Chicago professor John Mearsheimer's latest talk on the situation in Ukraine. He basically doesn't see, he says, look, it's a war of attrition. There's no opportunity left for negotiations, for, settlement here. All sides see it as an existential risk, basically, the outcome of this conflict, he says. Ukraine, obviously, fighting for survival. Russia sees it as an existential risk. If they lose this, they end up with, NATO anti-ballistic missiles, which can be repurposed into offensive missiles within a few hours on their border, and God knows what else. The US sees it as an existential risk, because if they lose in Ukraine, then this weakens their authority, and they've already got China breathing down their neck, Russia giving them the finger. It weakens their position vis-a-vis NATO. They're already barely holding China off with the Belt and Road Initiative, and it's it and Russia stitching together their new Middle Eastern, Pan-Asia Pacific transport routes, and doing deals with Iran and Turkey, etc., for moving their goods and services around. So he says nobody is prepared to come up with a settlement here. It's kind of a depressing scenario that he believes is going to be a war of attrition, aka trench warfare from World War I. It's just going to go on and on and on until one side runs out of money or people, or something dramatic happens to, the leadership in that country where they lose the will to go on. But it's not a positive assessment by any stretch of the imagination.
Yeah, sorry about that, Dennis. That's Mearsheimer's take on things. I don't know. I mean, there seems to be no Kissinger at the moment going in trying to broker a settlement, which is probably by design. But, you know, I would have thought Russia could redraw the borders and become comfortable. And if NATO doesn't put missiles into Ukraine, that's the obvious settlement. They've just got to come to that meeting of minds, and it's still a long way from that.
Well, that was the original offer, you know, going back April last year, when it looks, for all intents and purposes, that Zelensky was prepared to meet and have these negotiations, until Boris Johnson, who was still the PM of the UK at the time, turned up on his doorstep in the middle of the night and looks like told him not to do it. Basically, we don't know the context of that, the content of that discussion, but on a Friday, Zelensky said he was going to meet and negotiate a settlement, and on Sunday he said that was off the table after Boris Johnson had visited. And yeah, it's you know, Dennis, you know, tells me that their drone and missile defenses are working well in Kiev, not letting much through. So they're holding out, and hopefully that will continue. But, you know, I think everybody hopes that this thing will come to an end soon for all involved, for the Ukrainians and for the Russians. You know, it's a terrible, terrible situation for everyone, losing their lives, and their, you know, particularly in the Ukrainians, their homes and their livelihoods and families and friends and all that kind of stuff.
And there are some other wild cards going on too that we won't foresee. And Germany's gone into recession in the last week. So the appetite in Europe, if Europe goes into a recession, to also fund and fight a war will lessen, I would have thought. If there's a change of government in the US, whether it's DeSantis or Trump, they're probably not going to, well, they might. DeSantis might want to fight the war, but Trump won't. He'll pull troops, and, well, no troops, but pull money out of the Ukraine, probably fly to Russia again and say what a great guy Vlad Putin is, but like he did last time. But yeah, who knows? So there's a few wild cards still to play as well.
Yeah, and this is a long time to go before the presidential election, so you know, it's barely started to ramp up over there. So we won't see any change there for, was it 18 months, end of next year?
Yeah,
the election
November 24.
Yeah, so you know, that's a long ways away.
Yep.
Interesting that with the debt ceiling negotiations, you know, when the Republicans in the midterms were fighting to take the is it the Senate that they got, or the House? I can't remember now. Whichever one it was, there was all these talks that once they took, you know, one of the houses, that they would pull back on the funding of the war in Ukraine. And they didn't. It's still, there's bipartisan support across the board. And as Mearsheimer points out, Congress, you know, the US is acting as a co-belligerent in this. They've funded $118 billion now of support for Ukraine. But Congress has never passed any legislation or act to say, had a vote on the fact that they're a co-belligerent in a war. Biden hasn't signed an executive order to say they're a co-belligerent in a war. And yet they're acting as if they're a co-belligerent in a war. And as I saw, I think Glenn Greenwald pointed out this week, Biden has gone back on every red line he has set for himself in the last year. Well, we're going to support them with the Jeeps and bullets, but not with tanks. Okay, now we're going to give them tanks, but we won't give them jets. Okay, now we're going to give them jets. It's just, but again, no act of war, no co-belligerency has been waved through. It's just full on. And my point was going to be in the debt ceiling negotiations. You know, the Republicans are pushing for Biden to cut this and that and the other out of the budget, but no mention of cutting back on military spending at all, be it Ukraine or anything else. You know, that's one thing they agree on.
Biden's a pretty transparent negotiator. He went early into the Ukraine war and said, well, the only thing that's off the table is Ukraine not being part of NATO.
Mm-hmm.
And he does that all the time. Here's my red line, and now you have to come and make me cross it. That's just the classic negotiating ploy. I'm not doing the show next week, Cam, and then sometime between now and then, you'll make it worth my while to do the show. That's classic. That's negotiating 101, and Biden just wheels it out every other week in the US. Yeah, I'm not cutting the budget to get the debt ceiling done. Okay, what's it going to take for you to cut the budget to get the debt ceiling done? No, not this, not that. And eventually they negotiate a deal.
Anyway, for those interested in what I think is one of the most intelligent analysts, a realist analyst, John Mearsheimer, go check out his Ukraine Salon. Look for that. Mearsheimer Ukraine Salon on YouTube. It's a good watch. All right, and I haven't finished Death's End yet, but I'm still plugging away at it, and it's just gets worse and worse.
They are I think they've made a Netflix series out of the first book, which hasn't aired yet. But I've got a feeling they've also made a Chinese series out of it too.
Oh, that'd be worth watching.
Yeah.
That's the reason I picked this up and reread it, as you told me they were making a Netflix series. So I read the first one, I don't know, years ago. So I picked it up and decided to reread it and finish the trilogy. It's depressing. Very, very depressing. Anyway, we talked a lot about that last week.
Yeah.
That is the show for this week, TK. Thank you for joining me as always. Thank you for the people who sent in questions and for everyone listening. And just repeating once again, don't give up hope. There is light at the end of the tunnel. We just don't know where the end of the tunnel is yet, how far away it is. Hang in there.
Yeah. This is normal, people. There's always going to be short-term periods of underperformance, and they're always followed by periods of outperformance.
And you don't want to be the person who 2 years from now, when the market's going gangbusters, goes, oh, shit, I should have just stuck around and kept doing it. And then you wait until it's nearly its peak and you get back in, and then it goes through another downward cycle. And that's the journey that a lot of people go on, I think.
That's the classic retail investors' behavior.
Yeah. Get in towards the end of the boom and then ride it all the way down and get out towards the bottom and
lick your wounds.
Yeah.
Wait a couple of years. Yeah.
And then it's just too hard. I just couldn't do it. It's too difficult. What you got to do is just keep doing it.
Yeah. You see, and then stay out of the market for a couple of years until all your friends go, oh, this market's great. I'm making so much money. You should get in.
Yeah. All right. Have a good week.
All right.
What are you doing? What are you going to Wagga? Have a good trip to Wagga, TK.
Yeah, thank you. Playing some golf with Ruddy.
Say hi to Ruddy for me.
Okay, mate.
Cheers.
Have a good week. See ya.
You too. Bye.